Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. In our last video, we talked all about the home buying process, and in this video, we're going to go more into depth on mortgages. So, let's just have a little refresher. What is a mortgage?
A mortgage is a debt that is secured by a piece of real estate, typically a home. So that it's just that simple. It's instead of calling it a loan, I mean it is a loan, but it's just simply referred to as a mortgage when it's the loan that's used to buy a house.
Okay. And now, are there more than one kind of mortgage?
Well, there are several different kinds. You can have a fixed mortgage, which means that the interest rate on it does not change. So it doesn't matter what happens with interest rates in the world and everything else, it stays the same, which means basically the payment will stay the same. The payment will not change. Or you can have an adjustable rate mortgage. And that is one where if interest rates rise, typically your mortgage interest rates will rise, and with that your payment will rise. And vice versa. If interest rates go down, your payment will go down.
Okay.
So the two, are, you have to look at where you are in terms of your ability to afford things, where interest rates might be in the future, everything else to make a decision as to what's best for you. The second aspect of it is how long the mortgage is. The vast majority of mortgages are 30-year mortgages. Okay, so the people are going out 30 years with it.
Yeah.
However, it's not uncommon to find people who have a 15-year mortgage.
Okay.
And some people literally like the idea of paying off the house within 15 years. And, then if they need home equity to put kids through college, they can take a home equity loan and use that to, use that money to put kids through college. And then they're just starting the cycle over again, right? Now they just owe money again.
Yeah.
But that is how some people want to do it. Other people just want to have it paid off sooner. They just want to be out of debt as quickly as possible.
Yeah. So now that we know what types of mortgages there are, how do we apply for one?
Well, to apply for a mortgage, you're typically going to work with either a realtor, or you're going to go to an online website and look at mortgage possibilities. There are wonderful websites to work with to find a good low-cost mortgage, a low-interest rate mortgage, etc. You have to look at what the basics are of purchasing a property, and that plays into how much mortgage you may take and whether or not you can qualify and get that mortgage, okay? So the standard way of financing a property is to have a down payment, meaning cash that you've saved, of 20% of the cost of the house, combined with 80% of a mortgage for the house, okay?
That 80% is a fixed rate that you pay each month.
Well, it's going to be if you get a mortgage.
Yes.
So take a house for $300,000, okay? You might put down $60,000 and your mortgage would be $240,000.
Okay.
And that $240,000 is going to get paid off over, let's say, 360 payments, 30 years at 7% interest, okay? So there's a certain dollar amount that creates as a mortgage payment when you have that group of variables.
Yeah.
Okay? And now, whatever that monthly payment is going to be looked at by the people that issue the mortgage to make sure that you financially are in a position to pay that back. Okay? So what they're going to look at first is your income. How much income do you make? And typically what they want to see is that your income is at least, that the payment itself, including property taxes and insurance on the house, that monthly amount doesn't exceed about 28% of your total income every month, okay? So that's the first test that they're going to look at. The second test that they're going to look at is that all of the other debts that you have, like student loans, car loans, any credit cards that you're not paying off on a regular basis, any other kinds of loans, that all of that doesn't exceed another 5% so that 33% of your monthly payments is the maximum amount that they would allow be going for debt. Because it just, if you have more than that, it just crimps your ability to live. Yeah. So they're going to look at that first. The third thing they're going to look at is your credit history, meaning what's your history of paying off debts when you've had debts? Are you paying off your credit cards on time? Have you had any other loans? Are you paying off your student loans? Are you paying off a car loan on time? And if you're paying everything off and you have a credit rating that's high enough, they'll look at the two things together, and they say, okay, this is a risk we're willing to take. It fits within the parameters that we need it to fit within. And we will give a mortgage commitment, meaning we will say, yes, we're going to issue this mortgage to you, maybe under the following conditions, terms, whatever it might be. Now, I talked about a 20% down payment earlier.
Yeah.
It is possible to have a lower down payment, and it's
make
become
a higher monthly payment.
It will make a higher monthly payment, but 20% as a down payment has gotten harder and harder for people to make because housing has gotten so expensive.
Yeah.
So you can put down a smaller percentage. Generally speaking, if you put down under that 20% number, you're going to have to pay something called PMI every month. It stands for Private Mortgage Insurance. And basically what it does is it provides a bit of protection to the bank that if you don't pay back the mortgage and they have to sell the house, they still will get back their original amount of mortgage. That's what it's designed to do, okay? So PMI, though, is just another monthly cost. So now what you've done is you've added a higher mortgage because you have a smaller down payment, and which is a higher payment, and you've added the PMI. So now you get into a territory where, gee, maybe do I meet those other standards of percentages of income, given that I now have some higher expenses that I didn't have before.
Definitely.
So it's a difficult balancing act between how much money you put down and how much of a mortgage you are going to be allowed to carry. But if you pass it, and if you're married, the joint, the two of you together, if you pass that, then again, they'll give you a mortgage commitment, and then whatever the house is that you've signed up to purchase, you'll be ready to present that to the seller rather, so that they know that you're going to go forward with the purchase. And probably 2 weeks, 3 weeks after that, you'll probably own the house. So it's a good day.
Alrighty, now that we have applied for our loan and we have gotten our mortgage loan, let's talk about the actual concept behind amortization.
Amortization basically means that over that 15-year or 30-year period of time, slowly at first, very slowly at first, the actual amount of debt that you have goes down with each payment that you make. So the amortization schedule is by how much the principal goes down with every payment you make. And here's the reason why. Each payment that you make on your mortgage contains a portion of it that goes towards the principal on the mortgage, meaning the balance, the debt that you have, and the interest that you owe on the mortgage. So for every month that you have, you could take the principal balance and multiply it by the interest rate divided by 12 for 1 month. And roughly that amount is what you're going to owe that month in interest on the mortgage. Okay. Now at the beginning, that number is pretty high, and the principal amount that you're paying off is pretty low. As a result of that, the principal doesn't move very much for a long time. It takes a while for it to start to really go down, because what changes is that the next payment, because the balance is a little bit lower, because you did pay some principal. With the next payment that you make, the interest is a little bit lower. And the payment stays the same, which means that the principal part is a little higher. You pay a little bit more of the debt off. And the following month, it happens again. A little bit less interest, a little more principal, a little less debt.
Okay.
Little bit and little bit, little bit.
Yeah.
And you do that now for 10, 15 years. And finally, you start to make some significant headway in paying down the mortgage. Towards the end of the mortgage, and this is basically a curve, you know, if you remember anything from school, it's a logarithmic curve. I know that's getting into the weeds. Okay. But what happens is towards the end of the mortgage, because the mortgage balance is going down, the payment part of the principal gets bigger and bigger and bigger, and the mortgage goes down even that much faster. The debt goes down even that much faster because there's less and less and less interest. So towards the end of it, you're paying off a lot of principal.
Yeah.
And you have a lot less interest expense on the mortgage at that point. But so amortization is that whole process where in that 30-year period of time or 15-year period of time, you can see how much in interest you're paying, how much in principal you're paying, how the balance drops over time. That's what that schedule tells you.
Okay. Yeah, it's a lot to think about, but I think that makes sense.
Yeah.
You know, where if the monthly payment is the same each month, then it makes sense that as your balance goes down, you're able to pay more of that in your principal. So you're paying off that debt, and as you do that, the interest payment is going down.
Correct.
But you still have the same monthly payment, so your principal goes up.
That's correct.
Which means you're actually taking off more of the debt.
Correct, exactly.
I get it. Okay, I hope you do too. I think that makes sense. Well, that is all for this video on mortgages. Hopefully it was easy to understand, and now you feel ready to tackle your own. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website, and make sure to click on to the next.